Hello, everybody. Well, first and foremost, I'm Steve Boucher. I don't have a name tag. So if you're wondering who I am, that's who I am. But first and foremost, thank you for really, no pun intended, weathering the storm and making it to our presentation. We went back and forth. We didn't want to cancel. It's been 3 years since we've seen you. We've missed you. And for our new clients, this is something we love to do every year. And now that the last 3 years is behind us, that C word, COVID, hopefully going forward, no more interruptions. So I can't thank you enough for coming out. And I think you're really going to enjoy the presentation. So let's get started. Tonight's the 2023 State of the Economy. And tonight we're going to go over the state of the firm, 2022 in review. We'll try to make that as quick as possible because we want to get that out of our memory bank real quick. What's driving investment sentiment, challenges and opportunities, planning perspectives, market and portfolio outlook, and then questions and answers. And speaking of question and answers, for those of you that are comfortable with technology on your cell phone, on each of your seats, there's a barcode. And if you just take a picture of it on your phone, you'll be able to ask questions. And we encourage you to ask questions because at the end, that's how we're going to do the question and answer. And there's also going to be polling that as we go along, there's going to be questions that you're going to be able to help kind of give us your thoughts on. So, state of the firm. And I'll start off the presentation and go over because I can't be any more proud other than my family of my work family. We're 19 professionals. I continue to invest in some really talented, amazing individuals that I'm surrounded by. Each and every one of them smarter than me, and that makes me look smarter than I really am. Right now we have 6 certified financial planners, 4 CPAs, 1 certified divorce financial analyst, not that we want you to use her services, 1 accredited investment fiduciary, and we just brought on an IRS enrolled agent. Why would we have such expertise? And I'll get into that soon. So I just want to stop real quick and point out our leadership team, especially for our new clients that may not know and understand and realize just how much I lean on these guys. So John Millay, who's one of our presenters tonight, John's been with me for almost 13 years. We had a sister company that we sold last year, and John was very instrumental in really running that business, and it was a very successful business. So he was so good at the job that I only met with him once a quarter for like 15 minutes. That's how great of a job he did. And John is now, we really sold that company so that John can kind of cross the tracks and help us with Boucher Financial Group. So John kind of acts as our Chief Operating Officer, Wealth Advisor. He's also a CPA. Ryan Boucher, my brother, and Ryan's a CPA and a CFP. And Ryan is, we say, our Chief Strategy Officer. Ryan is always thinking about what we can do, how we can do it better, what's going on in the industry. He brings to light a lot of just great things that we're able to incorporate into our firm and how we work with you as our clients. And Marty Shields. Marty and Ryan have been with me now almost 11 years. Marty back then was one of the best advisors I've ever seen. And he's still one of the best advisors I've ever seen. So he hasn't lost anything in the 11 years that he's been with me. But Marty's our Chief Wealth Advisor. He kind of coaches and mentors all of the advisors that we have that are working with you. So I'm really in good hands. I really rely on these 3 individuals to help me. And it's really just a really great makeup of expertise. So what have we done? We've launched our tax planning services, which, as you can see, Nicole is one of our CPAs, 4 CPAs, and that 1 enrolled tax agent who will be starting real soon. So we're doing more tax planning for clients, and we're happy to do that. So many so many questions, and we have that expertise to be able to help answer those questions. We have some new hires over the last year. Katie Buck, where's Katie? Katie is recently joined our team as a junior financial planning associate, and she's really been a great addition. And for those of you that are doing some financial planning, Katie is like behind the scenes, the odds behind the scenes. Shelly Vitor, our client concierge. Shelly is just, usually your first point of contact is either Shelly or Angie Gavin. And Shelly's been with us. When did you join us, Shelly? Yeah, so when we had 120 people last night, she thought that was to celebrate her 1-year anniversary. And then we have Ed Wilhelm. And Ed joined us. Ed's been with us now 6 months. Ed is a recent graduate of Siena. He was the captain of the rugby team. Go ahead, Ed, show them your physique. But he really was the captain of the rugby team. And I know that because I flew home not too long ago next to an English gentleman. And we were talking, where are you going? Oh, I'm going to Albany. I'm from England. My son played rugby at Siena. I said, you're not going to believe this, but I just, we have a new hire, one of our associates is Ed Wilhelm. Oh my God, I know Ed. Ed and my son are friends. And so I really do believe Ed was the captain of the rugby team. And then a couple of our associates we're very proud of. Vincenzo Testa, where's Vincenzo? He's my godfather. Vincenzo, he's a CPA. He joined us from one of the big 4 accounting firms recently. And not only that, but he just is a certified financial planner as well. He and Ryan are both dual certified CPA, CFP. And where's Samantha Macy is all set to be a CFP. In 2 months, she will be, because there has to be so much work experience. Sam passed her CFP, and it's not an easy test to pass. I tried to tell him when I took it 33 years ago, it paled in comparison to the test that they have to take today. So Sam is really our newest CFP, and she'll be able to call herself a CFP in May. And then we have Nicole Goebel, who is one of our wealth advisors who relocated her family from New Jersey. And as Ryan said, when he interviewed her, and he interviewed her for about 6 months before I really knew Nicole existed. And he said, Dad, she may be the best hire or the best interview that I've ever had. And Nicole is very experienced, and I mean very experienced. She's a CPA and our newest certified divorce financial analyst, just in case things don't go well. So we continue to grow our team, invest in our human capital and technology. One of the reasons why, and we don't really advertise this a lot, but Charles Schwab benchmark studies 1,400 wealth management firms around the country. And we're always in the top 3 to 5%. And they really look at, how many factors, John? Oh, over 100? John spends weeks just going over it, and we're consistently in the country, the top 3 to 5%. I always say we're the quiet ones. And I think it's because of the investment we've made in our team, a team that's second to none, expertise that you can trust. And we continue to invest in technology for you as clients to have more information at your disposal, and for us, my whole team, to be able to work with you in a much more efficient manner. And then last but not least, we were voted again as one of the best places to work by the Albany Business Review, an honor that we've had many times. And that's on me to make sure that I continue to make sure I show my appreciation, and make sure that I do everything I can for my team in order for them to feel like they have that balance in life, doing a great job for you and also being able to have some time with their family. And it's important for me to treat them right. And in return, they continue to vote us one of the best places to work. So I'm very, very honored about that. And real quick, we have our historic downtown Troy location, and we moved out of Latham about 20 years ago, actually just 21 years ago. And we're still in downtown Troy. We have our Saratoga Springs office. We've been up here for about 15, 16 years. Ryan is opening an office in Boston, and Ryan will straddle that office and come back here to work with clients. And then we've been spending more time. I've been spending more time in Florida. We have a lot of clients there, and I'm trying to work on my golf game. But no, in all seriousness, we have an office in Florida because we have so many clients in Florida. So we're trying to just make sure we're able to take care of our clients when and where we need to, because right now we have clients in 25 states, France, and the UK. So even if you decide to retire and you go elsewhere, that doesn't scare us. We have clients all throughout the country. One of the things, and I think you saw through the photo scroll, one of the things I'm very proud of, along with everybody on my team, because they're all involved in it, is giving back to the community. And this is just a small, smattering of the not-for-profits that are near and dear to our heart, and being able to do everything we can. You saw some pictures. I said last night, I've been to Walmart 3 times now, buying thousands of dollars of gift cards that I hand out to people that I sense can use it. And I go to, different agencies, let's say, where I know that people are up against it. Inflation, which you're going to hear a lot about. A lot of us can afford that extra $2 at the gas pump, or the extra $30, $40 at the grocery store, or the extra whatever in your heating bills. But there's a lot of people out there that can't. And those are the people that I try to help out the most. And they think I'm crazy at Walmart when I go in and they say, really, you want all these gift cards? I said, I do. And if you can give me the ones that, because they have them where there's no alcohol or tobacco, I really, really look for that. So we're very proud of how much we give back. And I'm telling you, we're approaching, through all the years that I've been committed to this, in hundreds of thousands of dollars. And I'm not bragging, I'm actually proud. I mean, in the high hundreds of thousands of dollars. I'm very committed to giving back to our community in so many ways. We have a lot of our team members that are on different boards in the community, and president, like Marty's the president of the Ronald McDonald House, and that's just an organization that you'll tear up when you see these little ones and the families and what they're up against. So we're very, very committed to giving back to the community. And we all, as a team, will do volunteer days and try to do our best to make sure we show our appreciation to the community. So without any further ado, I'd like to ask John Millay to come up and talk about 2022, and we'll see you in a few short minutes.
Thank you, Stephen. So at this point of the presentation, we're going to turn to a review of 2022. And it doesn't fall on me that they give this to the new guy to go over this section. So bear with me here. Okay, so 2022 was all about the Fed. I mean, I don't know how many times you heard it, but I think I heard 1 million times last year, don't fight the Fed, whether it was on the TV, reading it on the internet. It was all about the Fed. And it was as short ago as August of 2021, where Fed Chairman Jerome Powell, in defending policymaker decisions, said inflation's transitory, denying that it was persistent. However, it was only a short few months, actually March of 2022, where the Fed started their first of 7 interest rate hikes in 2022. So in a very short period of time, we went from inflation is transitory to the Fed having to aggressively increase interest rates. And why were they putting the screws to the economy? Why were they raising interest rates? Because of inflation. Inflation had peaked in June of 2022 at 9.1%, significantly higher than the Fed target of 2%. So the Fed has been unequivocal. They're going to do what they have to do to get inflation down near the target. And they've stuck to their guns there. They raised interest rates 7 times. We'll see next week what happens in 2023, but they've certainly said they want to get inflation under control. So 2022 was the 3rd worst year for diversification using the classic balanced portfolio of 60% stock, 40% bonds. So the combination of a bear equity market and the depressed bond market created this situation last year where no asset class was safe. There was nowhere to hide. Now remember, there's an inverse relationship between interest rates and bond values. So as the Fed was increasing interest rates, that was causing the bond markets to go down. So we had this correlation. Stocks were going down, bonds were going down. The net effect was that that classic 60-40 balanced portfolio went down 17% for the year. Yep. So what was different in 2022? What was different was that typically as we're heading into a bear market, we see interest rates declining. So think about that. When I talked about the inverse relationship between interest rates and bonds, so as we're heading into a bear market, equity values are going down, but we typically also see interest rates coming down. So because of that inverse relationship, bond values would go up, giving us that balanced approach we want. Equities going down at a time where bonds are going up to balance that out. However, you can see from the chart, that was not the case in 2022. We had the equity market heading into bear territory at the same time that we had the Fed aggressively raising interest rates, creating this perfect storm where stocks were down, bond market was down, creating no safe place for any asset class. So the classic diversified portfolio 60-40, it was down last year, no question. But was it out? Should we rule it out? And that's absolutely not. We are long-term investors at Boucher, and you should be as well. So we have that long-time horizon. And over the long term, that balanced portfolio has paid handsome dividends. It's rewarded us. And so, yes, it's been down. It was down last year, and it was an outlier year, no question, third worst ever. But because of that outlier year, we should not give up on that strategy. And this chart shows when that 60-40 portfolio declines by 10% or more, on average, in the next 12 months, we see a recovery of almost 8%. Over the next 36 months, we see a recovery of almost 18%. And over 60 months, see a recovery of almost 37%. So yes, the balanced 60-40 diversified portfolio took a hit last year, but we should not give up on that as a long-term investment strategy. So in recap, 2022 was a year to forget. We're glad to see it in the rearview mirror. As we talked about, market moves were largely driven by the Fed, inflation, and interest rates. However, we can't discount the fact that the war in Ukraine was going on. We had China's zero COVID policy, and supply chain disruptions also impacted the market. Historically, we don't see rising interest rates heading into a bear market. So we had what it created was a correlation. Both stocks and bonds were moving down in the same direction. That's not what the balanced portfolio is meant to achieve. And bonds lost almost as much as stocks. Now, diversification has underperformed in the past, right? And again, last year was certainly an outlier, but long-term investors, we've seen over the long term that balanced, diversified approach pays off. And we shouldn't give up on that strategy just because we had an outlier year. Now, all these factors had a negative impact on investor sentiment in 2022. At this point of the presentation, I'm going to turn it over to Ryan Boucher, who's going to talk about what investor sentiment in 2023 is looking like. Ryan?
Thank you, John. All right. Thank you, John. And as we've said before, we're so happy to be here in person with all of you after a long absence. So thank you for coming tonight. And it's so great to see each and every one of you. So let's talk about investor sentiment a little bit, right? After a year like last year, the headlines that we're seeing, there tends to be a lot of negative sentiment out there. But for right now, we want to hear from you. How do you feel, about the markets, the economy? What has you worried? Or maybe you're feeling more optimistic. Maybe you're a little bit of a contrarian from what you're seeing in the headlines today. So is it inflation, recession, bear market, our current political environment? Is it overseas concerns? Or like I said, are you maybe more optimistic? We'll give this a couple more seconds or close to a minute. We're getting some good responses tonight. I'll give it a few more seconds. And we really shouldn't be surprised because these results are actually pretty close to yesterday's. Although we did add the I'm more optimistic. So it's good to see that we do have some contrarians in the crowd. Although after today, you may find yourself not as contrarian as you may think. So let's jump into it, but that's interesting. So yesterday was the same thing. Current political environment was the leading one. All right, let's talk about some of these at a high level for right now. Let's jump into inflation. So obviously inflation's been in the headlines for a long time. This chart, we don't have to get into every little piece of data in this chart, but I think it's a great representation of what we've seen over the last 2 years. So this shows the last 24 months, as you can see on the left-hand side, 2021, the right-hand side, 2022. And you see that peak that John talked about in the summer of 2022. You can kind of see that red line right down the chart. But since then, over the last 6 to 7 months, we've seen somewhat of a cooling, and that's what that green represents. The green shows a slowing down or non-existent inflation versus the orange and red is where inflation is really on the rise. And, what I'd like to point out here is that, goods, energy, some of those that we've talked about this past year, we truly are seeing a slowdown in those inflationary factors. What remains high, and we circled in the bottom right-hand corner, is more the core services. And that really sort of falls in line with just our spending habits since COVID. We've pulled back a little bit on goods and we've put more into services. So shelter, housing, travel, transportation, those are still relatively high. But as we get into some more detail and more data further in the presentation, we'll see how even there's signs of that slowing down as well. So inflation is showing some positive signs in terms of slowing down overall. We talk about a recession, right? And, if you're scared of a recession or a bear market, but I think what's not talked enough about is the potential that we've already have probably started a recession, whether it's from slowing down of GDP numbers. We've actually seen an earnings recession, really outside of energy companies. Most sectors have experienced an earnings recession over the last 2 quarters, and we'll get into that a little bit more. You're seeing leading indicators, you're seeing the inversion of the yield curve, which we'll talk about, all these factors in play. And so on the left-hand side of this chart shows the S&P returns of the last 75 years of all months. And you can see 1-year average is a little over 12%, 3-year average total is about 42%, 5-year average being 80%. When we look at those returns in the S&P 500, post-recessionary starts, they're still positive, even in a 1-year increment. So 1 year about 6%, 3-year average 43%, 5-year average 70%. Meaning, the market and the economy, especially at peaks and troughs, can somewhat diverge from each other. And even if we've seen the start of a recession or recession may be on the horizon, if we have some patience through this, markets tend to do well following it. As the leading, fear factor tonight being politics, I do want to talk about politics a little bit. And really the message is trying not to mix politics with investment. So I'm going to try to explain this chart. So we're going to look at the energy sector here. And I think, one of the most divisive issues in Washington between Republicans and Democrats tends to have to do with energy, with global warming. It's a hot topic in Washington. And if you look at the green chart, and so this chart goes back to when President Trump was elected. So it goes back a little bit more than 6 years. The green graph is a global clean energy index. The orange graph on the bottom is the traditional energy index, XLE. So think of Chevron, Mobil, Exxon. And the blue is just the S&P 500 as a data point, as a reference point. When you think about where you would put money maybe in a Republican presidency, you would think maybe traditional energy would outperform clean energy, right? Well, if you look at those 4 years, the clean energy index in green way outperformed, even the S&P was up almost 300% over those 4 years. When you look in that red line when President Biden came into office, That clean energy index, believe it or not, came crashing down pretty hard, where traditional energy companies have done really, really well over the last 2 years. Now, this is just one small snapshot, one small segment. But when you think about, you hear pundits on the news saying, hey, where should I be because of this election cycle? Or, if Democrats elected or Republicans elected, the investments in economy do not always fall in line with what you may think. So I think this is just a great snapshot to highlight that difference and what we really need to keep in perspective. And here again, just a quick snapshot. And I'm glad we put 2 slides on politics because again, it was the leading fear indicator right tonight. But if you look over time, over the last almost 100 years, whether it's been a Democratic presidency, a Republican presidency, the market's done pretty well over that time. And, I think the message from this is that our corporations are pretty resilient. They do adapt with what they're given, whether it's laws, whether it's, trust me, I understand the frustration in Congress. I feel it the same way, but our corporations have been pretty resilient, and over time, the market tends to do well, no matter who's in office. And lastly, I just want to leave you with this snapshot as well. For those fears of a bear market, and they're true. I mean, we see it, we talk to clients all the time, and, we feel that with you. When you look over the last 100 years, we've experienced close to 20 different bear markets. The good news is over that time, most of those bear markets, the average has been about 9 to 10 months. And why it doesn't feel good, having that long-term approach, when you see how much more we've experienced bull markets versus bear markets, we have to keep that in mind when we're looking out and when we're looking ahead. We have to keep that perspective. So when we take a step back, again, at a very high level, should we be concerned right now? Well, we're seeing inflation is slowing. It may persist at elevated levels, but it is slowing down. A recession could be here. We already may be in one, but I think a lot of companies, it's been the most talked about recession ever almost. I think companies, the good thing is they should be prepared right now. Try not to mix politics with our investment strategies. We'll talk to you about that, later or individual meetings, but we want to really drive that home. We didn't talk about it in the slides, but there's certainly overseas concerns right now. Those are some of those high risk, but low probability, systematic types of risks that we go through, and it's hard to diversify away from it. We'll be aware of it, but, we'll keep in mind. Bear markets tend to be shorter than bull markets. The recovery will happen before there's any good news out there. And with all that, I want to turn it over to Marty. That's going to get into a little bit more of the detail behind some of this economic data.
Thank you, Ryan. I want to reiterate what Ryan said, how great it is to be here. We love doing these events, and it's great to be able to spend some time with you and chat. Before we go into the challenges and opportunities, I'd like to get your thoughts on what you're either experiencing or hearing with the labor markets. So there have been headlines of some of these big tech companies laying off folks, but what are you seeing out there? Do you know many people getting promotions and new jobs and raises? Are you starting to hear about people losing their jobs and having to take a pay cut? Is it more of a mixed bag of what you're hearing, or are you retired and you are avoiding any conversations on retirement? Or I'm working, which is appropriate. Oh, I love that. That number up there. Okay. And just like yesterday, it was a mixed bag, was the #1 result down at Troy as well. So seeing some of the similar items as that. Well, let's start with a point that's an opportunity. I tend to be an optimist, so let's go there first. So one of the things that Ryan and John talked about is with inflation having peaked last year at 9.1% in June, and has been trending down. It hit 6.5% in December, and the Fed has a target of 2%. But what I'd say is if we can get inflation anywhere down to 3.5, certainly 2.5%, that's going to be pretty good. The Fed, I don't think we have to get quite to 2. If we can keep that trend going, we could be in this kind of Goldilocks type of situation. It's called having a soft landing with the economy. And what this graph shows you is the federal funds rate. So the federal funds rate is a very short-term rate. It's an overnight rate that the Federal Reserve controls. You can see that last year it went from close to 0% up to 4.5%. and is expected to be raised probably another 0.5 percentage point over the next few months. But then we could see a situation where the Federal Reserve pauses on that. And if they pause because the inflation data is trending downwards, that can be a good situation for the economy and for the markets. And it's a narrow window for this to happen, but it is possible that we can kind of get that Goldilocks situation where inflation keeps going down and the Federal Reserve pauses for the time being. But there will be some challenges to that. There's a number of components in the CPI, Consumer Price Index, that may not cooperate. One of which is commodities. You're starting to see oil prices move up. Copper prices are moving up, and this is a little bit of a function of China coming back online. You're also seeing labor markets being very strong. Walmart just came out yesterday. They're going to be increasing the minimum wage for their associates from $12 an hour to $14 an hour. That's a 15% increase. And in general, you're seeing a lot of strength in the labor markets. And then also in the housing markets, in particular on the apartment side, there's an awful lot of demand for apartments. So when you look at the overall housing market, what you're seeing is weakness, right? You have 30-year mortgage rates going from 3% to 7%. You know, you can't afford as much house when you're paying a 7% mortgage payment on that. So housing prices have come down about 10%. But what this has done is driven people into the apartment market, and vacancies are at really low levels from a historical perspective. And that means that rental rates are going up. And it's important to understand that in the CPI, it's rental rates that is captured at about 25 or 30% of the CPI. So if this continues to be the case, this could make that trend a little bit more difficult to happen. I think it's also important to understand what is the mentality or outlook of Jay Powell, who's the chairman of the Federal Reserve. So as John had mentioned, you know, really a big mistake about a year and a half, 2 years ago when he called inflation transitory. I think, you know, we all have situations we wish we didn't say something. He wish he didn't say that. He wish he acted a little differently. But now he's looking at history for some guidance, and he's looking towards Paul Volcker for that guidance. So Paul Volcker was the chair of the Federal Reserve back in the late 70s, early 80s, and he was successful in crushing that very high inflation, if you remember, during that time period, and it set up the very successful economic situation of the 80s. So he's going to be looking to be aggressive towards inflation. Who he's not going to mirror is Art Smith. Art Smith was the chair of the Federal Reserve during the 70s. And under his tenure, inflation basically thrived. He was a little soft on it, and it started to go away, and then it would come back. That was basically stagflation. So you're going to see Jay Powell really go and look and talk like Paul Volcker, and he's going to be aggressive towards inflation. So if you're not seeing it trend downwards, it's not going to be a great opportunity for a soft landing. We've talked about yield curves in these meetings before, and it's an important indicator where we may be. So the bottom curve is the yield curve that existed in December 31st, 2021. That's what's more like a normal or a healthy yield curve. And all a yield curve is telling you the interest rate you can get for different maturities, in this case on the US Treasuries. So it makes sense the longer out you go on that yield curve that you can get a higher interest rate. And the shorter maturities, it's a lower interest rate. Well, now not only have interest rates increased, now we're up to the blue yield curve above that, but we have a situation where the short maturities are actually providing a higher yield than the longer maturities. And in particular, one that stands out is the 3-month T-bill is higher than the 10-month T-bill. And the reason that's important is you look from a historical perspective, it's occurred 8 times in the last 50 years. 7 of those 8 times we were either in or going into a recession. So it's a pretty accurate indicator of what might be coming. The other thing we look at is what's going on in the banking industry. And when banks are lending and they're loosening their standards, that puts a lot of money into the economy. When they're going the other way and they're tightening their standards because they're concerned about the economy, that pulls money out of the economy. What I've done is there's 5 circles here. 4 of them are past times when we've got into tightening situations. And you'll see there's a gray bar underneath those. Those are recessions. So 4 different times when banks have tightened, we've either been in a recession or we went into one. The other area we look at is unemployment and wage growth. So the blue line below is wage growth, and the black gray line is the unemployment rate. And what you see is in times of economic boom, you have those two lines converge. And matter of fact, this time we're on the far right-hand side. Not only did they converge, they went past each other. So right now, our wage growth is 5.8%, while our unemployment rate is at a historic low of 3.5%. But what you'll also see is that does not go on forever. At some point, unemployment starts going back up and wage growth goes down. And one of the themes you're going to hear us talk about, interest rates and inflation are important, but what's really important is profitability. We're going to be looking at profits of corporations, because at the end of the day, if you're a stockholder, you want your corporations to increase cash flow, increase their profits. And they have to be able to either increase prices or sell more goods or lower costs to be able to do that. One of the things that we're looking at in the Russell 2000, there are 800 companies that are now unprofitable. Now, those could be good companies. They could be, new into an industry. And just because they're not profitable doesn't mean they're not good companies. But these types of companies tend to struggle in times of economic uncertainty. So from our portfolios, as we construct them, we're going to try to remove those types of companies that are unprofitable. We're going to be looking for companies that have good cash flow and solid balance sheets and are profitable. So as Ryan mentioned, in general, politics does not really impact the markets over the long term. But in the short term, there are situations where that can actually happen. So in this cartoon, you have the donkey that represents the Democrats. The Republicans are represented by the elephant, and they're saying, okay, the first to blink as they're on top of the elevator going towards the ceiling. So we've already actually hit that ceiling. It happened a week or two ago, and Janet Yellen, who's the Secretary of the Treasury, is going through what's called extraordinary measures to allow cash flow to keep going out from the government. But we're going to come into a tipping point in June or July. And just to give you some perspective on this, we have raised the debt ceiling 78 times since 1960. We've done it 20 times since 2001. So it happens all the time. Many times you don't even know it's happening. But we've had situations where we've had a political divide like we have now, in particular in 2011, and we basically went to the brink. Now, they did raise it, but it wasn't before the Standard & Poor's downgraded U.S. debt, and there was market volatility. So this would be something that we're going to be watching very closely to see how this goes and if we need to make any adjustments to the portfolio. Now, let's go on to some opportunities. So, one of the things that we look at is what do balance sheets look like? What is the net worth of companies, of governments, and individuals? And this shows you that, relatively speaking, the amount of debt that individuals have on their balance sheets compared to the amount of income they have is at historic levels, low levels. And that's important because, as we've talked about before, the consumer makes up around 80% of the GDP. So if they're in a healthy spot and don't have a lot of debt, they're not over leveraged, even if we hit bad economic times, we'll get through that. And that's important. And then we see this also with corporations, and we see this with states. The other thing, too, is, right now, investor sentiment and consumer sentiment is very low. And as Ryan mentioned, from a contrarian perspective, that's a good thing. You want that low. That means there's a lot of cash in the sidelines that if the market starts moving forward, it will come back into the market. Having that long-term perspective is important. And I think this is very compelling. What this looks at and says, if you have a year where the market's down 20%, what is the 1 year, 3 year, and 5 year cumulative performance of the market? This is the average performance. Well, 1 year out, you're up 22% on average. 3 years out, you're up 41%. And 5 years out, you're up 72%. So that's really compelling that, yes, we may have even more volatility as we go through this year. But when we're talking really long term, we've got some very strong performance numbers that we'll probably see. So to summarize, there is the opportunity for a soft landing. It's going to be a narrow runway, but that opportunity does exist where the economy can do well and the markets do well. We may have some challenges as we move forward through this year, but that does not preclude us from having a positive year throughout the full year. In 2009, if you remember, that was a bad start to that year. The market moved all the way down until the beginning part of March. but that year was a great year in the market. So again, there may be volatility this year as we move through some of these items, but it doesn't preclude it being a positive year. But the big element there here, if we want to communicate, is long-term, we think we're still in a secular bull market. And all that means is when we look at things like artificial intelligence, that's completely changing the way that corporations are operating. They're able to increase productivity and profitability. When we're looking at the changes that they're going to have to exist for electric vehicles and the amount of infrastructure that's going to have to be invested, when we're looking at changes from an oil and gas powered economy to something that's more green energy, all these things are tremendous amount of investments that increase profitability for companies. So we're very much of the mindset that we're going to be in continuing a secular bull market. But, you know, I'm talking about things that are really out of your control. And one of the most important things you can do is really focus on the things you can control. And that's planning and working with our advisors. So I'm going to hand this off to Nicole, and she's going to give you some thoughts on what you could do in your own personal situation.
Hello. So thank you all for coming out. Today is my first State of the Economy, so I appreciate being up here. I joined the team a little less than 2 years ago, and thanks for all of the great information thus far. So before we get started, I'd like to ask another question. What elements of financial planning are most important to you? Retirement planning, tax optimization, legacy planning, insurance planning, or is there something else? See a lot of retirement planning. Great. Some tax optimization. We do a lot of that. Wonderful. Okay, so we're going to talk about some of these topics and really how they may pertain to you. So retirement planning tops it off. So I'd like to talk about some of the topics that clients reached out to us to discuss over the last year, just to share some of the things that maybe you should be talking to us about if you're not yet engaging us for these services. So one topic that really applies to almost everyone is Social Security planning, right? So at some point, whether it's going into retirement or, you know, earlier in your career, you're thinking about when should I elect to receive Social Security? And we're making some assumptions in your financial plans. So we can help you with those decisions. If you're lucky enough to still have a pension from a former employer, again, making decisions related to survivorship benefits or when you begin to take those benefits. Distribution planning. So we did an entire webinar on distribution planning in the fall, but really thinking about once you're no longer working and you need to start living off of your portfolio that you've saved for many years, where should you start taking those funds from? What types of accounts and what amounts? And how does that impact your tax situation? And thinking really long term when you're thinking about each year and where you're going to take those distributions. Employer retirement plans. For any of you who are still working, although we can't manage those assets in-house, we're still here to help you. So whether that's determining how much you're contributing, whether you're contributing pre-tax or Roth funds, and just ensuring that your asset allocation is in line with your overall financial plan. Roth conversions, certainly a hot topic for the last few years. So does it make sense for you to pay taxes today to move funds from your traditional IRA or your employer plan into a Roth IRA, right? So that can grow tax-free and be tax-free upon distribution later, but you're paying taxes today. It really depends on your situation. So we're happy to talk to each and every one of you about that. Equity compensation. We work with many clients who have, whether it's stock options, restricted stock, or the ability to participate in an employee stock purchase plan. Should you be participating? What type of election should you make? Managing taxes around vesting of those awards. We're here to help with all of that. And deferred compensation plans. Some private employers have non-qualified deferred compensation plans for executives that allow you to put more money away than just your normal employer retirement plans. But again, should you be utilizing them? What are the risks? And what are the things you should be thinking about before putting money into those plans? As I mentioned before, these are some of the topics that we worked with clients on last year. But just to give you an idea of all of the services that we offer and can be a conduit to for you, let's think about it. BFG can be your personal family office, right? You don't have to have $20 million to have your own personal family office. We have a team of 19 professionals here. Steve talked about all of the professional designations that we have, all of the expertise. We're here for you. So financial planning, we work with most of you on that. And if we're not yet, please give us a call. Tax planning, as Steve said, in-house, we have now 4 CPAs, an enrolled agent. And we really, again, can work with not only you, but if you have a CPA or a tax preparer you know and trust, we're happy to work with them and coordinate with them directly. Estate and trust planning. I get a lot of questions. I'm not an attorney, but I am here to help with those meetings. And also, as Steve showed, we have so many connections to the community. So we can refer you to somebody that we know and trust that can work with you on these other important factors in your financial lives. More importantly, when you draft an estate plan, it's really important to actually work through what you need to do, updating beneficiaries, funding your trust, retitling accounts. So we're here in our client service team, who is amazing, to do all of that for you. Business planning. If you're a business owner, thinking about succession planning, creating and managing retirement plans for you and your employees. And insurance planning. I'm really happy we don't sell insurance, but we do see that sometimes there is a need for insurance in our financial plans. So whether it's life insurance, long-term care, property and casualty, we're here to refer you to somebody that we know and trust to put the right product in place for you. Another aspect of what we do with our clients is working with your extended family. I did meet one of our clients who brought their daughter tonight, and I offered to her that we're welcoming anyone to basically say, hey, can you please have a 20-minute conversation with my daughter, my son, my brother-in-law? I just want to make sure that he's getting the right guidance. She's getting the right guidance. We're fiduciaries. We have to act in the best interest of our clients. We don't sell anything. So you can trust that we're going to put that person on the right path. So I know Marty's met with some of our clients with kids in elementary school because we've been asked, can you just teach them some basic financial concepts? Right? And it's great coming from a financial professional. We work with many young professionals. So whether that's managing savings and debt management, or your first job and you're determining, should I start saving into my retirement plan? You know, should I be electing this additional life insurance? What's the right choice? And again, those stock option benefits I mentioned as well. And then we bring it back to you, right? So if you're entering a stage in your life where you're thinking about, I want to get that estate plan in place, but I want to make sure my kids know what my wishes are and who should be handling things. And I want them to meet you and to talk to your team so that if anything happens, they need to start, moving things around and taking things over, that they know and trust you. So again, having those larger family meetings, we do that all of the time as well. And with multiple generations, and we're happy to do that. I'm going to switch gears for a second now and talk about some current events and planning with the newest Secure Act 2.0. So for those of you who remember a couple years ago, we had this lovely surprise at the end of 2019 that this big package passed that changed a lot of the rules around retirement plans. So the required minimum distribution age that had been 70 and a half was increased to 72. And there were quite a few other changes as well. Well, Secure Act 2.0 just further delayed distributions. So for anyone born from 1951 to 1959, you now don't need to take your distribution until age 73. If you're born after 1959, you actually get to defer all the way till age 75. So what does this mean? Basically, you have more years of tax deferred growth within your accounts, and we have more opportunity for planning to take distributions slowly at a lower tax bracket in your early years of retirement, or to do Roth conversions. So it just gives you more time for planning before you're forced to take those funds out. There's many other changes in the 400 pages, but I won't bore you with all of them. But just for those of you who are still working, you can now put a larger sum of money into employer retirement plans, $22,500, an extra $7,500 if you're over 50. Traditional and Roth IRA contributions went up to $6,500, or $7,500 if you're over age 50. Something new for anyone who's self-employed, you can now set up a Roth self-employed plan, a SEP IRA or simple IRA. There's also some additional changes that are going to be coming in the next couple of years that I've put up here. If you're a high earner, starting in 2024, you can only do Roth catch-up contributions. For those who can't yet afford to start saving into their retirement plans and are instead paying down student debt, now employers can actually make matching contributions to your plans on your behalf if you're just paying down student debt. And also there are some higher catch-up contributions for those ages 60 to 63, starting in 2025. We don't understand why they forgot everybody over 64 who's still working. Okay, one other item I just wanted to point out as a new release. 529 plans, traditionally used for college savings. We now have an option to, over the beneficiary's lifetime, move up to $35,000 into a Roth IRA. So you can see here I've put some of the different requirements, but this is a great new option, right? If you're lucky enough to not have spent down the entire balance of your 529 plan for your child, or maybe they are brilliant and they got scholarships, you always had the option to change the beneficiary to a different person, a different individual within your family. But now, right, when they start their job, if the account's been open for 15 years, it won't look at any assets that were added in the last 5 years, but you can transfer money to a Roth IRA, subject to the same annual limitations and the fact that they have to have some earnings. But this is a great tool. And 529 plans, right? You can change the ownership. So if someone passes away, you should have a successor owner on that account. Just like you can change the beneficiary, you can change the owner. So Marty and I were, in fact, discussing this earlier today. It's being used for legacy planning now too, because there's no requirement for you to have to take it out of that 529 plan wrapper. So in summary, I'd just like to say that if you're not yet utilizing us for all of the services I mentioned, call us. We're here for you. We want to make sure that we are serving you in any way possible in your financial lives. And if we don't know someone in-house that can do this, I'm sure there's someone within the community we can refer you to that, again, we know and trust. So I'm going to hand it back to Ryan, who's going to talk about what we see for this year and really the current market outlook.
All right. Thank you so much, Nicole. And it's such an important part of what we do is working with clients and really getting into their financial plans and working with each and every one of you. So I'm sure what many of you are here for tonight. What lies ahead? Let's look at market outlook and some portfolio perspectives. Now, I don't want this cartoon to scare you. We unfortunately do not draw them, but I think there's a very important takeaway here. It's not necessarily the two bears, but I do think there's a major shift in market perspective on the horizon, or we may already be there. And that is earnings. Earnings and fundamentals, I think, are going to come to the forefront of what the market does ahead. You know, John mentioned last year, so much of it was all about the Fed and inflation. I think we're really going to start seeing how fundamentals and earnings come more into play. So let's look at the last 25 years of S&P 500 fundamentals. So they look more attractive again. And what this chart shows you is the 25-year average price to equity ratio of the S&P 500 stocks. And what that measures is how much you're willing to pay for each dollar of earnings within these companies. So right now we're at about 16 times earnings, and that's right in line with where we've been over the last 25 years. You can see the spike as we got to the end of 2021, and, valuations and fundamentals were kind of getting away. They were way, way overvalued as we came out of COVID and we were sort of adjusting to this new normal post-COVID environment. But right now today, fundamentals look really, really solid. Now, there's been a change in earnings over 2022 and also earnings expectations heading into 2023. And the market has reflected that. So if you look at this chart, it's showing 2022 actual earnings in 2023 expected earnings moving forward. And what you can see is that between April and June, They peaked both for 2022 as well as what the expectations moving forward. We've seen, I talked about it earlier, we've actually seen an earnings recession already start to take place. We've seen forward earnings expectations come back. But what it also shows us is that the market's kind of more in line with where expectations are right now, even with a slowing economy, even with the potential of a recession. You know, again, from a fundamental standpoint, that could be a good thing. Now, this is an interesting chart, and I think you're hearing maybe in the headlines or in market news, sort of this shift from growth to value. As we get into a higher interest rate environment, valuations for growth companies do come into play a little bit more. It's harder to meet those current valuations as interest rates rise. And what this chart is showing you that over the last 100 years or so, that blue shade is all the time that value outperformed growth. The gray shade at the bottom is when growth outperformed value. And if you look over the last 100 years, you would say, wow, value has really, really outperformed over that time. But the last 12 years or so, we've seen this monumental shift in growth companies and how well they've done, how big part of the market they've become. So, if you look at that, when you look at the history and how it sort of flip-flops, well, now may be a good time to start looking towards value. And that may be the case, but there's more to it than that. And I'm going to go back to this slide. I actually removed a slide from last night's presentation. But the big story is that not only are we looking at, value and growth opportunities, but that nuance to it. It's what Marty brought up earlier. It's about profitability. It's about quality. It's about strength in balance sheets. It's about strength in cash flow. Are they able to grow their cash flow? Are they able to reward investors with that cash flow? And I think the big way to think about it is that, our growth companies today are not like the growth companies of 10, 15, 20 years ago. If you go back to the tech bubble, the 5 biggest companies back then, Microsoft, which is still the biggest, in the biggest grouping today, but you had Intel, Cisco, EMC. If you look at their balance sheets, they had very little cash on hand. Their balance sheets were not strong like those growth companies of today are. If you look at earnings, they are nowhere near where the earnings of today's tech leaders, the Facebooks, the Amazons, the Apples, Microsoft today versus 20 years ago. So, when we think about this divergence, we don't look at it as just growth versus value. We want to look for profitability. We want to look for quality. That could be some of those traditional growth companies. It may be some value companies or somewhere in between. I think there's going to be a lot of opportunity ahead. And we've already started doing that within the portfolios. We started making some of those changes back in September and October of this year. Where do we see opportunities today? So this chart, the light green scatter plot shows where valuations were at the end of 2021. The dark green circles show where valuations are currently or at the end of 2022. And this goes through pretty much every major asset class: municipal bonds, treasuries, corporate bonds, international stocks, US stocks. But the big takeaway is we see, one, valuations are much more in line with where we want them. They're, in fact, in many asset classes, they're actually below the 20-year average, which is that black line running through the middle. The other thing is we're seeing opportunities more so than ever, especially in areas like fixed income, whether it's municipal bonds or corporate bonds, treasuries and government bonds. There's a lot of opportunities. So to John's point earlier, having that diversification, yes, it didn't feel good last year, but there may be more opportunities ahead to get diversified or stay diversified. The market's response to crisis. I know we've seen, plenty of charts like this tonight, but when we look at the last 7 major crises over the last, 40 years or so, Black Monday, dot-com crash, 9/11, the global financial crisis. Every time outside of the dot-com crisis or the dot-com crash, which was, prolonged because of 9/11, within 3 years, which is that yellow bar, a 60-40 portfolio has recovered, and it's done really well. After 5 years, each and every one of those times, the market has recovered. So we still think, even though there may be some challenging times in the near term, we think that there's plenty of opportunities within the portfolio ahead. So what does that mean for the market outlook? Well, as I stated earlier, we do think there's going to be a major paradigm shift happening. We're already kind of seeing it happen especially over these next few weeks as earnings from last year are coming out. I think earnings fundamentals are going to be the key driver as we enter 2022. Current profitability versus that future potential. Again, it's not so much growth versus value. It's about quality and profitability. We don't think it's time to give up on diversification. We think there's going to be opportunities, and there were opportunities that we took advantage of in the bond market. Still optimism for stocks. We don't expect maybe a sharp recovery like we saw coming out of COVID, but we do think that there's room for stocks to recover. We think patience will be rewarded. And we've already talked about the fact that maybe we're in a recession, but what if there's no major recessionary catalyst? We may see, some of the down, the markets at one point were down 25% last year. That was reflected in those earnings, in some of these recessionary expectations. The market is reflecting, even though it felt like it was being driven by rates and the Fed and inflation, a lot of that did come back to earnings. It wasn't as talked about as much, but it was there. So how may it impact our portfolios going forward? Well, we started making some defensive shifts last year. As you can see, we had some healthcare staples. We added those dividend stocks. And to us, those dividend stocks, companies that have been increasing their dividends over 15, 20 years or more, those are quality companies, good cash flow, strong balance sheets, ability to reward their investors. Like I said, we're going to continue looking for those quality and profitability factors moving forward. 60-40 portfolio, a lot of opportunity for that being back. Again, bonds look good right now. Stocks have an opportunity to recover, but maybe with some added help. We used a lot of alternatives last year. That may continue moving forward. We use some hedged equity positions. We're looking at more as we enter this phase right now, which a hedged equity position does capture upside. It may not be up as much as the market is, but it's meant to protect if we see further volatility on the downside. We had a JP Morgan equity premium income fund. Again, the evolution of the ETF industry has allowed us to get more complexity in the portfolio through an ETF. And that's one where invest in a lot of derivatives, but it's meant to be very protective and defensive in down markets. And that's what we're looking for, things that can help us if we continue to see some volatility in the short term. And like I stated before, plenty of opportunities in fixed income. We saw that chart. That's where most of the fundamentals and valuations look most attractive right now, is in that part of the world and part of the investment universe. So with that, we want to open it up to you. I saw earlier we had some questions already coming through the app. This application it's very easy to use. If you haven't gotten into it yet, please do so. If you have questions, you can ask them right there. And we're going to ask Harmony Wagner to come up and help facilitate some of the question and answer segment. So thank you, everybody.
All right, we have some great questions here. A couple I'll answer right off the bat. They're more logistical. A few people asked if the slides will be available after the event. When the recording is live on our website, there will be a link to the slides there as well. So you can get it there. And if anyone wants them sooner, you can email myself or Sam or anyone on the team and we can make those available to you. Let's go with this one first. So someone asked, bonds have been in a bear market, some would say for 20 plus years. Therefore, where do we put safe money?
So I've been talking about this for a long time. So as you know, I've been helping clients for 36 years, and bonds have been in a bull market, literally, for almost 40 years, going back to the early 80s. The U.S. 10-year Treasury note back in 1981, September of 81, was yielding almost 16%. And just about a year and a half ago, it was as low as 0.52%. And as Ryan pointed out, the yield at the end of last year was 1.7 or 1.9, or Marty pointed it out, and it went all the way up to 4.2% just a few weeks ago. And here we are now somewhere around 3.5%. Is John talked about, there's an inverse relationship of when yields go up, the price of the bonds go down. So go think about the last 40 years when that 10-year yield was 16% and it went all the way down to 0.52. That means the value of bonds were going up. And that's a bull market when the price of bonds are going up. So you were getting a good yield and you were getting total return because you were getting appreciation on the price of bonds. So here we are. bonds now are, last year was one of the worst years ever for bonds. The 30-year bond was down over 30%. The S&P was down 19.5%, and the US 10-year Treasury was down about 16%. As John pointed out, there was no place to hide. I'm, for the first time in a long time, giddy about bonds. Last year, bonds we did not have in the portfolio until late fall, and we started adding them because they looked attractive to us. We got out of them anticipating bonds to have a crazy year last year, and we were right on the mark with that by adding our alternatives. So right now, where do you go for safe money? You're getting some good yields. Marty showed that inverse yield chart, and you can get short-term bonds, 1 year, 2 year, 3 year, that are yielding more than a 5 or 10-year bond. That's what inverse means. So for people that need money over the next couple of years, we've been putting our clients' money, our safe money that we're doing in these type bonds where we're getting a decent yield. And Marty and I on the radio were talking about the savings bonds where, back in May, you were getting almost 9%, just a little bit over 9%. Well, that's come down a lot. Inflation has come down, and that resets every 6 months. So for those of you that like to keep a little bit of money somewhere real safe outside of your Schwab account, an iBond makes sense. So right now, actually, yields look pretty attractive. And as I said, the bond and stock market look to be good bargains right now, and we've been buying back in the bonds. Ryan is heading up the investment committee, he and Paolo LaPietra, and they started us buying back in the bonds, and we're pretty excited about that. Long-winded answer, but bonds are an important part about your portfolio, so I just wanted to take a couple extra seconds on that.
Is it ever a better choice to take money from investment to pay down or pay off a mortgage, or is it not a good idea to do that?
I'll take this one, Harmony. Like many things, this is really a personal finance question. I think in many questions or many areas here, it sort of depends, right? It depends on what's the interest rate, what's your mortgage rate. I think it may also depend if you're looking at it from a data perspective. Is the market, at the end or, peaking at a high bull market, high valuations, bad fundamentals versus maybe the market being down today? Right now with the markets being off, somewhere around 20%, maybe even more in some areas, taking that money out of the market, we probably wouldn't recommend that. Now, if you're getting into, if your interest rate was in the 6-7% range, maybe there's an argument to be made there. But if you're holding a mortgage at 3.5%, some cases maybe even under 3%, the numbers over the long term, it's hard to make that up. It's really a arbitrage opportunity to get that sort of loan at a low rate. But again, rates are a lot higher now, but the market's also down a lot more. So taking that money out of the markets today may not be as attractive. So I think it sort of depends. We've worked with retirees who maybe had a smaller mortgage, but it made sense from a data perspective or analytics perspective to keep that money in the market. But it didn't change their financial plan all that much if they did want to pay that off and they felt more comfortable. So I think in many cases, it really does depend. But over the long term, I would say with historical interest rates being lower than they were into 2022, it's made more sense to keep that money in the markets.
Someone asked, how long from the Fed's last rate increase in this cycle do you think it will be for them to start reducing rates? And maybe if I could just reframe it a little bit, obviously no one can see the future, but if you were to say, what the path towards, the Fed's actions over the next couple of years might be and what might influence them to pause or cut rates.
So, the Fed has said they're data driven, right? They're going to be looking at the current economic data and making their decisions based on that. I talked about this soft landing piece that would allow them to pause and potentially pivot. You would really need to see inflation head down pretty low. I don't see them pivoting and lowering rates unless inflation is well below 2%. You have to start moving down there. The only other reason they would start to pivot the other way is if the economy really started to decline and they were concerned about it. But, I talked about what is the playbook that Jay Powell's using. It's Paul Volcker, not Art Smith, right? So he's going to make sure that it is well taken care of. Inflation is not going to come back before that pivot happens. The thing to remember is, historically speaking, this tends to take longer than most people anticipate. If you look at times when, you think the Fed is either going to start raising rates or lower rates, it goes on longer than you might anticipate. So, it is a big unknown, but, I think this year, unless something dramatically, it had to be a dramatic change. I don't see them lowering rates. Certainly, I doubt it would happen this year unless something dramatic happened.
A lot of questions about bonds. I'll pose this one to you, gentlemen. Do you recommend a client to buy 3-month T-bills? So they can certainly function. What you might see as part of what we're doing for a lot of our clients is as part of a bond ladder. So buying some that are longer term, locking in some of these higher interest rates that may not go much higher relatively to the trajectory of the past year, or that you may not be able to buy in at such a high interest rate at the end of that term. And also a good opportunity to use them would be if you have a cash need in the short term. They are one of the higher yields at this point in time. So if you're going to be paying taxes and you only have a few months to invest it, it's a good place to put cash short term, or again, to utilize that as part of a bond ladder. Given the challenges of 2022, what was the main disappointment with Boucher investment strategy, and what do you consider a success? So what was a win, and what might we have done different if we had a crystal ball?
Well, I have to take that because, I always say my heart aches and breaks whenever a client loses a dollar, and I take it to bed with me. I really do. I care about each and every one of my clients. And I'm telling you, I'm proud that 100% of my family's money is invested just like yours. And I'm even prouder to say that all of my advisors, all of their monies are invested just like yours. This is something that a lot of firms can't ever say. We're proud to say it. We put our money in the same investments that we put your money in. And last year was one of those years. We've lived, a lot of clients here tonight have lived through the Great Recession 15 years ago when the S&P was down 50% over 18 months. October of 07 through March of 09. We lived 3 years ago when the S&P was down 34% in a few short weeks. But why did last year, with the S&P being down 19.4%, feel so much different? And it really did. And John pointed out, we had at the beginning of the year, we had COVID lingering. We had China going into that lockdown. We had the Russia-Ukraine war. We had supply chain issues that kept popping up. We had inflation peaking at 9.1% in the early summer. We had, as Marty pointed out, the Fed talking a really tough talk, and they're talking tough because they need to. They need to prove, as Marty said more than once, that they're not going to allow inflation to get out of hand. Now, the thing that we have no control over is, where will inflation come? I think Marty and I have talked many times. I'm in the camp that I don't think inflation is coming back down under 2%. I don't see how it can. And the one big reason is wage growth. For 40 years, if you think about it, the American worker was really taking it on the chin. When I look, and there's one statistic that I look at often, when you look at wages, net wages, that's after inflation, what workers have been getting paid just 2 years ago was exactly net of inflation, what they were getting paid in the 70s. So for almost 40 years plus, the average wage did not keep up with inflation, and that's important. Now, COVID came along and it changed all of our lives. But the one thing that it did change was companies have had to change how they treat their employees. And I'm very good with this. I say it often on the radio. I don't care if Walmart makes less money because they're paying their employees more hourly wages. Marty pointed out $12 to $14. Target is $15 an hour. Costco is $17 an hour. Amazon is $19 an hour. Just 3.5 years ago, that all of those hourly wages were under $10. I feel good that so many people are able to provide for their families, put food on the table, pay their mortgage because they're being paid more. Now, this is where the rub comes in. And Jay Powell is very, very bound to determine he wants inflation to come down. He wants us to lose more money in the stock market, and he wants people to be unemployed. Now, it sounds crazy, right? Why would somebody want all of those bad things to happen? But they're textbook savvy, and that's what history has taught them. I am in the camp. I don't think wages are going to come down just because inflation is coming down. I think that American worker, I don't think how Walmart, all of a sudden, if inflation does come down and meet the target, that Walmart can say, hey, we're going to reduce your hourly wage from $14 back to 12 or 10. I think those days are over. And this is something that's important. So I really, I truly think that if we look at last year, the one thing, and our job is hard. When we have clients stay put, we do that because we know the market's going to turn around. We just don't know when the market's going to turn around. When that market turns around, you need to be in it. I mean, year to date, we're up 5% almost in the S&P, almost 10% in NASDAQ. If you got scared out of the markets, and we hear this often, I can't afford to lose any more money. Well, you haven't lost anything if you haven't sold. It's just on paper. Once you sell, you realize those losses, and you never know when that market's going to turn around. You need to be in the markets when it turns around. The one thing that I'm sure of, and I try to tell my clients all the time, the market will recover. It will go back to make all-time highs. You just have to be patient. And all of our clients are, because we keep 1 to 2 years worth of their cash needs off to the side. So we have time to make that back. So last year, it was hard keeping clients in the market. I'm not sure in hindsight, other than us running for the hills, and maybe that could have worked. Our prudence, our methodology, our research, Ryan and Paulo heading up the investment team with some help from Ed and Dave Clark, our director of operations. You know, we got a good handle on the investments, and I'm in the camp that this year you'll see the markets turn around. I think next week you're going to see the Fed lower how much they raise rates. We were at 0.75 for 4 times, then 0.5. We may go down to 0.25. We won't know till they come out. And then all of a sudden, as Marty pointed out, they're going to stop. And then before we know it, they're going to lower interest rates, because they have to lower interest rates to get the economy going, because they're going to kill the economy by if they hike interest rates too much. I'm getting the hook here. So you see that, right? He's my favorite son. So, so, you know, I'm not sure what we could have done different. Everything we did, we know was in the best interest of our clients. It just hurts because last year there was no place to hide. Both stocks and bonds went down, and that affected everybody, even the conservative investors. So I'm going to stop there. We're going to take one more question, and then we'll wrap it up.
What percentage do you feel gas and energy affected inflation?
I'm not taking that.
It actually, if impacts, if we're talking about the consumer price index, we're only talking about 15%, maybe 20%. It's not as much as you may think. Again, one of the largest factors is apartment rental rates. That is basically, it's called the housing equivalent, is the biggest factor in there. So, you know, the one thing though, it's important is, you know, we're talking about a consumer price index. That's a measurement, right? It's what do people experience? When you go to the gas pump and you do that all the time and you see that price, and you could be making a lot of money or you could be making minimum wage. When you go and you see that, it impacts you. So, you know, I think as far as what actual inflation was and, you know, what it's reported as, not as much as you might expect. But I think from a mental perspective, it really gets people riled up when they see that. I think the other thing is when you go to the grocery store You bring all the food back and you're like, I just bought the same amount of food for 10% less, a month ago. So I think those are the things that you do all the time. You really realize how inflation's impacting you.
Oh, I was just gonna say, I know we had a lot of great questions and we want to make sure everyone gets on the road in time tonight, but if anyone wants to reach out to us afterwards, and I saw one question, if the slides will be available, and they will be. So we'll email the presentation out. We'll email a copy of the slides as well, and you'll be able to find them on the website.
And the presentation will be on the website soon. Last night, I think we had over 100 people viewing this presentation virtually. So let me wrap it up. I want to thank Nicole and John for being up here. Marty and Ryan, I mean, you've seen them do this State of the Economy presentation, how many years now? And I mean, I can't say enough about the expertise. And Harmony. Harmony's been with us almost 7 years, one of our wealth advisors and a CFP, and she's just amazing in her own right. Before I let the service team go, because our success is each and every one of us adding and doing everything we can for you. And the service team, they're really the hard workers behind the scenes. Unfortunately, Angela Cesny, who's been with us now 25 years, she couldn't be here tonight, nor could Angie Gavin, who's been with me. I thought she was with me 17 years. Last night, she reminded me, she says, you forget 19 years ago, next week, we were getting our nails done at Kimberly's and you hired me because I said I was, and I said, yeah, I did forget that. And now, I'm a metrosexual and I'm okay with that. But it's a true story. Angie's been with me for 19 years. And I have to just, Andrea Gehring and Jamie Durkee and Shelley Bitor, who you met earlier. I mean, our service team, and Nicole pointed it out as well. They are what makes us go. So we want to get you out of here. We want you to leave swiftly so you get home. We kept you a little bit longer than we wanted to, but I can't thank you enough for coming this evening. And as Ryan said, any questions that you have, we'll try to put them out. Maybe we can do like a little white paper and answer all the questions, because there's some great questions that Harmony had that we just couldn't get to. So safe travels home, stay healthy, and thank you for coming.